So, Tom Hayes, the one and only, it's good to have you back, and congratulations on your interview just recently with Yahoo Finance.
And I really don't think we're in a situation like the pandemic where the uncertainty was that high. Now they just need to ease up a little bit on the action. They've got a little bit too much the last 3 hikes. You might kill the patient with too much medicine.
That's possibly a good introduction. I think everyone should follow you. You are delivering great insights, and today we're talking about the markets in general, China a little bit in specific, and of course Alibaba. And yeah, the fun part is, like, the last time I had you on the channel, I think that was in May, Alibaba was trading around $88, and yeah, you basically presented two opportunities there, China and biotech, right? And both kind of took off in June and have since then come down quite a bit. Has anything changed on your perspectives regarding Alibaba, like Chinese stocks in particular there?
Yeah, I think a couple of things. First off, thanks for having me on your show, Marcel. You've got a wonderful audience. I see them on Twitter. They're fully engaged, and you really deliver a lot of value for them. So I appreciate that. I would say, I've spent some time. I mean, Alibaba bottomed in March around $73 a share on the US ADS. And then when we spoke, as you said, in May, it was in the mid 80s, and now it's back in the mid 80s. But I think we're through the worst of it. I mean, we are seeing more and more regions reopening in China. We saw the good news in Macau that they're going to be reopening. But the beauty of these periods that are perceived as tough times actually cause you to go back and sharpen your pencil. And we all know the general story. You own a third of Ant Financial, which is very valuable. They have a lot of cash. The e-commerce business will grow when things normalize. And the cloud business is the kind of free option moving forward. I want to kind of drill down on the cloud business because I didn't even realize the magnitude of what that means moving forward until I really put a sharp pencil to it of late. And what sparked that was McKinsey a few weeks ago. The big consulting firm came out with a report that said China's public cloud market was going to triple in size in the next couple of years, from $32 billion today to $90 billion by 2025. So that's very, very fast growth. Now, Alibaba has 36.7% of the market currently. I think that share will actually grow because due to the regulatory crackdowns and the unfavorable business environment with COVID-0 that businesses had to contend with for the last 12 to 24 months, which is going away, I think Baba is going to be kind of the last man standing. Tencent is very far behind in terms of cloud share. I think they're at about 11%. If you look at the business when it gets to scale, and I'm going to compare it to Amazon Web Services, which has a 29% operating margin today. If you look at that $90 billion market by 2025, assuming they don't grow share and they retain a 36.7% share, that's $33.3 billion top line compared to about $11.8 billion right now. But the magic of that is going to be the operating leverage. So as you get to scale, we saw the same thing with Amazon Web Services. Once you get to 20 and 30 billion, you start to get into that 29% operating margin region. That's going to be $10 billion of new operating income to Alibaba. Now, why is that important? Well, let's assume that the rest of their businesses don't grow anymore, which, by the way, is a completely faulty assumption because, I just had lunch last week, well, both dinner and lunch, with one of the largest developers in Istanbul, Turkey. They actually build the soccer stadiums in all of Africa, the airports, the hotels. And we were talking, and I was talking to them about online e-commerce platforms in Turkey and accompanying countries. And they're like, well, Alibaba made an acquisition and they're just growing like crazy, 23% per year compound annual growth rate on the top line. And there's no end in sight. They're going to be expanding aggressively to surrounding countries and Eastern Europe, and they're just going to dominate. And that's like just getting started. So leaving aside that the international is going to grow, the Chinese is going to rebound, forget the commerce business. Let's just assume that that's zero. And the current operating income, of which about right now, the total contribution of cloud to operating income is 180 million. Because at $11 billion of revenue, they have no scale. At 30 billion, they're going to have major scale and they're going to get that 29% operating margin. But the current operating income is 15.2. So if you add $10 billion of operating income to that. You're looking at 25, 26 billion if you add it to last 12 months versus peak, pandemic peak, which was 16.7 billion. And what that means in English is this: you basically have 60% more operating income in 2025, just on the basis of the cloud growth, assuming nothing else grows, than you did at the peak when Alibaba's ADS was trading at $319 a share. To put that in perspective, we're trading at, $84, $85 a share today. And that assumes peak multiple. So if you apply the peak multiple that the market assigned when the stock was trading at 319 with the growth in cloud by 2025, you're looking at a $510 stock, assuming nothing else grows. Now, let's just cut that in half and assume that we don't get a peak multiple, that we actually get a trough multiple, and no one ever becomes euphoric about Chinese stocks again, and they just give them the lowest historic multiple. You're looking at a $200 to $250 stock. And again, that assigns zero credit for the cash on the balance sheet, zero credit for owning a third of Ant Financial, which, by the way, was originally going to IPO at $300 billion. The business has grown in the interim, but maybe the market assigns $150 billion today because of the pessimism. At some time in the future, that business will be worth $500 billion to $1 trillion. That may be 8 or 10 years out. And as owners of Alibaba, you own a third. So when I do the sum of the parts, and I continue to just assign zero growth to the domestic and international e-commerce growth, which I think both of which are just starting in terms of recovery from zero COVID, in terms of pro-growth policies that have been aggressively in place since March, but not being felt in the economy due to the COVID zero. That is now ending. And then you've got the China National Congress in a couple of weeks. And if you look at the people that Xi wants to run economic policy post-election, they're very pro-growth and pro-consumption. So, your upside case just on the cloud is, 510 with a full multiple, assuming nothing else grows. And downside case 250. The key is waiting through the short-term volatility and dealing with it and adding opportunistically when the market has its fits and emotional ups and downs. But I've not seen a business set up like this at this scale with this level of moat in my career. I've certainly seen special situations in the smaller mid cap that were many multi-baggers, and those are a little easier to find. But in terms of what Alibaba is offering today, I just continue to look at the valuation, and even Marcel, before I sharpen my pencil on the cloud and what that means moving forward, I think I talked last time to your viewers. You basically have a business that's grown. The total business has grown revenues 800% since 2014, earnings 500% since 2014, and you can buy it for less than 2014 prices, and no one wants it. And that's the beauty of the mania of Mr. Market. As Ben Graham taught us in The Intelligent Investor, serving up euphoric prices and despondent prices within a matter of months and years. And right now we're in the despondent prices phase, and you can't give them away. And I can assure you, whether it's 1, 2, or 3 years from now, we'll be back in the euphoric phase, and we'll be laying off our stock, that we own in the low hundreds to people in probably the mid 400s and mid 300s, and maybe a few shares that we hold on to above 500. And that sounds like pie in the sky, but if you actually do the math, could something happen? Could you have you always have to assign small probabilities. Could you have a China-Taiwan conflict? Sure, you could have that, but everyone kind of knows that, and that's probably priced in here. Could you have a continuation of ridiculous a crackdown that had happened 12 months ago? You have it every 3 to 5 years. They do the same exact thing. Could it persist a little longer? Sure. I mean, this one has persisted longer than I had anticipated. But leaving that all aside, the business continues to grow. And, even though they work at it 24 hours a day, 7 days a week, they can't seem to kill it.
Fantastic. I love the long-term view there. And but that would have been my question regarding the cloud business. And first of all, I tend to agree that, this is a really big growing market. And usually we talk about China on this channel on where they're kind of leapfrogging technology and what they're doing. better possibly than others and where China's more advanced. But in the cloud business, they're actually lagging the US or the Western markets in adoption. And that's because like businesses are not really used to buy software from other companies. That's where they are in their development. So I totally see the potential there as well. But my question would be like, what would be the problems regarding regulations? Because this has been an attack on the big monopolies, if you will. And so what are the prospects of Alibaba Cloud despite the technology crackdowns in this environment, in your views?
Yeah, I think this is one area of the business that the government actually wants to facilitate. If you look at Amazon Web Service, by the way, to your point, they are behind. China's about exactly 6 years behind the U.S. So in 2016, AWS was doing 12.2 billion in revenue. Do you have any idea what they did last year?
No idea.
62.2 billion. And I think what's going to happen with Alibaba is going to, and by the way, on that 62 billion, it was 18.5 billion in operating income. So, we talk about 10 billion of new operating income for Alibaba by 2025. But if you look out to 2027, 2028, it could very easily be 18 to 20 because AWS isn't in those regions where they're going to grow extremely fast. So, get that 29% margins. And there's less competition. I mean, in the US, you've got AWS, you've got Oracle, you've got Google, you've got Azure, you've got all these places that are going to be less accepted in China than Ali Cloud. And with now the US cracking down on chip exports and technology, Alibaba is developing AI chips and special chips within the cloud. They'll kind of be the only game in town. So that 36.7% is very conservative in terms of share. I think more likely, like you saw with AWS, that 12 to 62 in just 5 years is more likely the outcome than 12 to 30 or 12 to 40 that we talked about in this. And 15 to 18 billion operating income could be the upside surprise as we look out to 2026, 2027. So I think the other thing that you're seeing in China is the government's figured out, having a record high youth unemployment rate of educated people that are at unrest is not a good thing for political stability. And that's probably one of the reasons that they backed off this time, which is usually the reason they back off every time. It just seems they have a very short-term memory and they forget every 3 to 5 years that the same thing happens over and over and over. And it's at their behest, and yet they never learn from their mistakes.
Right. And so maybe connected to that, what do you expect out of the party congress that's going on right now?
Yeah, I mean, we had all this intrigue a couple of weeks ago about a military coup. I did speak to some people with security clearance in the U.S. military, and it wasn't all empty. I mean, there was some smoke there with the flights being shut down and everything else. So we won't know in actuality what the outcome is. As you know, there are probably about 100 families that control everything in China. So it's not unfettered power that Xi has at any point in time. If the powers that be are dissatisfied with the policies and or the outcomes, he can easily be, maybe not easily, but he can be replaced and pretty abruptly, and that certainly wouldn't be a surprise. That said, following that, what you've seen is he's more public. He even went out yesterday without a mask. So I think that's a signal that following the China National Congress, you're going to see more of a pivot, whether explicit or implicit, that zero COVID is kind of a policy in more or less in the rearview mirror. If they have excessive flare-ups, then certainly maybe they'll have regional crackdowns again. But by and large, I think they've got to move forward to growth, and the people that he has in mind to run his economic policy are very pro-growth, very kind of not really aligned with zero COVID, and I think that's the direction they're going to take it. So whether there was some type of hiccup a couple of weeks ago, and they said if you want to continue, you're going to have to ease up and let the economy recover, or he just figured it out on his own. It really doesn't matter. The key is I think that pivot is imminent, and we've seen signs of that with Macau, and we've seen signs of that in different regions, and we've seen signs of that with him coming out of his cave and actually facing the public like the rest of the world has been doing for over 12 months now.
Do you think there are any concrete signals investors are looking for, like for the end of zero COVID? Because right now, it's still like, as you mentioned, like we have some small signals, but the stimulus is not going, it's still kind of under the hood, really.
Yeah, I think we've seen, we have seen some of the August data start to come in better than expected. I think retail sales were up 5.4%. So the consumer is coming back. You're seeing the anecdotes of the different travel stations, and they have their holiday this week, and travel is starting to recover. So, this is all at the will of the government, and the government seems to be now more open to people getting back to normalcy. There is naturally an extreme amount of deference and care for the elder in the population, which is what's behind the zero COVID policy and protecting their elders, and that's important. But at some point, if the economic machine doesn't run, the elders are at risk economically and in terms of their welfare as well. If the younger people aren't making a living to contribute to the family, so I think they pushed it as far as they can. I think that. All of that stimulus that has been injected into the system since March and even as early as November of last year, that has not trickled into the economy because it's largely been shut down, and people have had fear about the fits and starts of their businesses and jobs being shut down on a whim, is now starting to come out and trickle into the economy. And I do think that dollar for dollar, you see the rest of the world has been in this aggressive tightening. China is the only pocket of the world that has been aggressively easing. And I think that's going to be a positive thing for China. And I think that's going to be an underestimated positive for the rest of the world as we look forward. People are really underestimating that impact, because China has basically been out of the game for 12 to 18 months. And when they come back, it will have a meaningful impact.
Yeah, you mentioned two more points that I'd like to dig deeper. One is demographics, because usually that's always also an issue for investing in China because of the demographic pyramid, right? So where do you see this as a problem or even a catalyst in the short term? And the second one regarding the dollar strength and emerging markets in general, when do you expect this could turn out to be a catalyst, actually?
Well, I think you hit on two of the most important things that we'll talk about besides the Ali Cloud. First and foremost, it's going to be difficult to see massive flows into emerging markets before the dollar stops going up. The good news is it looks like maybe the dollar has stopped going up. It's off about 3% in the last few sessions. That is a huge boon to emerging markets, and that's critical that continues. Now, we've been saying for many weeks, and we've been early, that we believe that the dollar was going to stop going up and start to stabilize and grind sideways, and it maybe even come down. It's not because we have a crystal ball or we're some psychic. We look aggressively each week at data called the Commitments of Traders report that's put out by the CFTC. And if you look at the last 5 peaks in the US dollar over the last 20 years, every single time the dollar peaked, it was preceded by commercial hedgers getting aggressively short, which now they're the most short they've been in quite a long time, and they have been for the last couple of months. So we think that thesis is now starting to play out and should persist. If you see, number one, it just stopped going up, but God forbid it actually goes down, you're going to see flows into emerging markets like you haven't seen since the early 2000s. And we all know from 2002 to 2007 was one of the biggest booms in emerging markets in history. It's also supported by the demographics, which you point out. Now, if you study demographics country by country, region by region throughout history for the last 100 years, there's one common denominator, that the fastest growth is accompanied by housing and family formation. So when a population or a country has the largest segment of their population between 30 and 40, which are the highest spending years, they tend to do exceptionally well during those periods. And then when that bubble of population starts to age out over 40, that starts to slow materially, and their economy slows materially as well. So a good comparison for China is Japan in the late 80s. They had from 85 to 90, their population was basically, 34, 35, and then it grew. And by 89, 90, that huge portion of their population started hitting 40 years old, and their economy slowed, and it never recovered because they had a low birth rate. China right now has the second largest portion of their population is about 32 to 37 years old. It's kind of like our millennials in the United States. And so what we anticipate is the next 3 to 5 years will be the best years in China for decades to come. I think we're going to get one more massive euphoric run off this despondent low over the next 3 to 5 years. And then for everyone worried about China taking over the world, I think they can sleep easy at night. More likely than not, as we look out past 2030 or 2028, they'll be the next Japan, and they probably won't recover for decades and decades and decades. But that said, you could have had that view in 85, and if you didn't take advantage of the next 4 years, you missed out on fortunes, because it was really a parabolic move in Japanese equities and assets. And I think we're going to have a parabolic move in Chinese equities and assets over the next 3, 4, 5 years. And then when everyone is writing the books about China's century, and they're going to be the leader in the world, and maybe they will for a few quarters. Just like they had said that about Japan. If you remember, well, you probably don't, you're younger than I am, but they had this movie called Rising Sun, which was a blockbuster hit in 89, because Japan was buying Rockefeller Center in New York, and they were buying up all of these assets. And the Americans selling them these assets were like, sold to you. If you want to buy at that price, God bless you. And they just bought them back next year, several years later at huge discounts. They bought them back from the Japanese. And I think the same thing will happen with the Chinese. Everyone will flood into their markets as the dollar weakens. They'll benefit from the demographic tailwind that they have for the next 3 to 5 years. And then they'll hit a brick wall with a demographic headwind like Japan, and they'll struggle with that for decades to come. And all the books that will be written 2 or 3 years from now when they're flying will make good fodder to start your fire in your living room, come 2028 and 2030.
Tom, even as a China bull, I completely agree with your take on this one. And let's zoom out a little bit, because I think parts of it, why the final opportunity of investing in Alibaba or XBI, like biotech, hasn't come fully to fruition yet, is possibly because the markets have been tanking on uncertainty about inflation, right? So we persistently got, let's say, worse than expected inflation data coming in still. So what is your current views on that and going forward?
Yeah, I think the inflation data is backward looking. If you look at the underlying data, whether it's commodities, whether it's housing, whether even owner's equivalent rent, how it's calculated, et cetera, I think we're going to start to see those numbers improve in incoming prints, number one. I think the big issue has been the level of hawkishness by the Fed. And as we look forward, and we know that the underlying data is coming down, it's just a question of time when we're going to see it. Powell and company have been like a dog chasing their own tail. And I say that because when Powell came into power in 2018, his first meeting, he came out and said, we're in the middle of a trade war with China, by the way. We're going to keep quantitative tightening on autopilot, meaning we're not going to depend on the data to make our decisions. And within a couple of weeks, the market S&P 500 tanked 16.5%. Secretary Mnuchin had to come in, Treasury Secretary, and call 6 major banks on a Sunday evening, 2 days before Christmas, and basically assess their liquidity and make sure there was ample liquidity in the market, or it would have just continued to collapse. 5 days later, Powell walked back his hawkishness and his naivete, and the market rallied to new highs over the next few months. Then the second big mistake, strike two, was last September, exactly a year ago, give or take. They had their dot plot. They had GDP estimates for 2022 at 3.8%. They had PCE inflation at 4.2%. And they said inflation is transitory, and we think it makes sense to keep the Fed funds rate at 10 basis points and to continue with quantitative easing, despite the fact that houses had gone up 80% in some markets. So he was, like Winston Churchill said, all generals are prepared to fight the last war. And what was Powell doing? He was fighting the last war that almost destroyed him in his first time out in December 2018. He realized if he was too tight, the market would collapse on his head. Then he went too easy in 2021 at the exact wrong time. And now in September 2022, he's too tight at exactly the wrong time. What do I mean exactly the wrong time? Well, GDP estimates when they were loose were 3.8%. Now they're 0.2% for 2022. We've just had 2 quarters of negative GDP, which is a technical recession. If you look at the Atlanta GDP now, the last time I looked at it, it was at plus 0.3% for Q3, which implies it's possible and maybe probable that we had a third quarter of negative GDP. So if 2 quarters doesn't cut it, as it has for the last 4 decades, maybe 3 quarters will. And my guess is sometime after November 8th, which are the elections in the US, we'll get a declaration that we've already had a formal recession, or we're in a recession with 3 negative quarters of GDP. And then all of the pundits who've been out there saying we're going to get a recession in 2023 will have to recalculate it and say, wait, maybe we've already had it. Oh, wait. And if that's the case, the stock market always bottoms before the recession ends and before it's officially declared. So I think we may have already had the equity market bottoms in June and September. And the key is going to be whether the Fed blinks. And I think the Fed, like you saw last night, the Australian central bank pivoted. They said, we've done these emergency hikes. Now we're going to pause and see how it works. You saw Bank of England have to blink last week when the credit markets forced their hands. Usually policymakers are not proactive. As in the case of Australia, they're reactive. They're like a bunch of emotional day traders, as was the case of Bank of England. And then ECB pivoted in June when they had to create a second QE facility to buy bonds in the periphery, namely Italy, because their 10-year yield was at 9-year highs, at the highs that created the last European debt crisis. So the question is, will Powell be proactive and respond to what he saw in England and follow the course of Australia before things fully break? I mean, credit, if you look at the high yield market, credit spreads really blew out last week, starting to approach pandemic lows. And at that point, things start to really break, and it costs you a lot more money to solve an economic crisis than it does to just, read a history book and realize you've pushed it too far with the hawkish talk.
How high do you rate the chances that something is going to break? We had quite a bit of chatter, Credit Suisse last weekend. Do you think the Fed will be actually forced?
Yeah, I think that if you look at the odds of a 75 basis point hike, they've come down materially since the Bank of England pivoted last week. So I think now the likelihood is that they're going to move to 50 basis points in November. If that is the case, that will be viewed as a pivot, meaning they're starting to wind down the tightening process. I don't think they're going to be cutting anytime soon. I think if they stop, if the terminal rate is, potentially below 4, I know everyone's calling for 4.6 in first quarter of next year, but let's just assume that it's below 4. They might be able to sustain that for a year or two and make sure that inflation comes down over time. They don't have a choice. Chair Powell has this fantasy that he wants to be Paul Volcker. When Paul Volcker was raising rates to crush inflation in the early 80s, US debt to GDP was 30%. It's now 122%. Every 1% that he raises rates adds $285 billion annually to the federal budget deficit. So he's very limited. And when you think about that, who pays that extra $285 billion of interest expense? Well, it's the taxpayers, but not really, because we don't collect enough revenue. So what they actually have to do to pay for the increased interest expense is print more money. So the more hawkish they get, the more inflationary they actually are. I don't know if they've actually done the math on it, but so they have to be relatively dovish. Now, 375 basis point hikes in a row is not dovish. Those are emergency cuts. We've had about 88 rate hikes since the early 80s, 1983, 75 or 50 basis points or less. So to do 375s in a row is very serious. And at this point, they should just stop and pause and see the lagged effect as they've destroyed demand. You're seeing it in GDP with plus 30 basis points for Q3 GDP estimates. You're seeing it in 2 negative quarters of GDP so far this year. So I think they've actually done enough. If they pause now and just kept the Fed funds rate at this, effective 308, for a year or two, I think that would create a soft landing. I think that makes too much sense. They'll probably have to do 1 or 2 more hikes because they never learned from their mistakes. And then they'll have to backtrack and maybe cut a little bit. But if they've read a few history books, that would be the best solution. And we'll see how it turns out. But it does seem like with all the other central banks around the world having pivoted extremely or modestly, they'll be next, whether they know it or not. And it's likely at debt to GDP at 122%, the credit markets are already kind of forcing their hand. And maybe there has been one of those 400 PhDs that work at the Fed that actually did a little arithmetic and realized, wait a second, the more we raise, the more we have to print. That's probably not a good thing for inflation.
Let's talk about one last white swan event, if you will, and because I saw you liked my tweet, and I was actually saying, and it's only China as well as the Pope and Elon Musk saying that there should be peace between Ukraine and Russia. Not so much talk about this from the US and Europe yet, but do you expect anything of this coming out other than Elon Musk being criticized for his position? But do you think it could possibly and start a discussion and then also possibly a solution in the end for this war conflict?
It depends how cold it gets in Europe. I mean, that's really what it comes down to. I mean, these guys, they have.
That's why I'm in Mallorca, not in Germany.
Yeah, these idealistic views, but when they're, I've said the surest way to get removed from office is to have high food prices and high gas prices. And we're going to see that in November in the US. The Republicans are going to sweep the House. The Democrats will likely retain the Senate. But that's another white swan that the market's really not positioned for, is that the stock market loves gridlock. Regardless of who's in the executive branch, as long as you have some checks and balances, that means we're going to have no new taxes, no new major regulations for at least 2 years, which is very, very bullish for the stock market. You know, if you looked at positioning in September, and I sounded like a broken record in September, but you had managers at their highest cash level since the pandemic lows and since the great financial crisis lows. What we're facing right now at best is a slowdown. It's nothing along the lines of those two things. If the Fed pushes too hard, you'll have a temporary crisis, but they'll quickly backtrack and fix it like they did in 2015, 16, 2011. They'll chase their own tail. We're hopeful that they've read a couple history books and don't repeat the same mistakes over and over. So far, we have no evidence for that optimism, but maybe this time's different. Sentiment got down to 17.7% bullish on the AAII sentiment survey. Expectations for a recession were the highest since April of 2020. If you remember, the market bottomed in March of 2020. And before that, March of 2009, which was the low in the stock market. So, you know, I've been through a few of these. I've been to this movie before. I've been in a few rodeos. And I got to say, the pessimism and fear, I would even say over the last week, which seasonally, by the way, September was the worst month of the year, and last week was the worst week of the worst month. You know, the pessimism was really palpable. People were scared, and that's usually a point where you see some inflection in the market. So far, we're seeing it. You know, we'll have some fits and starts here. We'll see what the Fed does. The other thing is earnings expectations are extremely low, plus 3.2%. What most of the sell side analysts don't have any experience in is forecasting in periods of inflation. What they don't realize they're saying is that they're actually calling for negative 3% earnings growth, which I think is unrealistic for the best 500 companies in the world, because prices have doubled more than their growth estimates. So even if they sold quote unquote less units of their widget or of their service, prices are up 6% across the board. Plus, and these companies are the ones with the greatest pricing power in the world. So on a nominal basis, earnings are going to grow no matter how you slice it, even if they did less units because of the economic slowdown. And I think that's what people are missing. And that's why last quarter, everyone was calling for 20% reductions in forward estimates for the S&P 500. We got a modest 3%. Now they're calling even harder for 20% reductions. And I think they're going to be disappointed once again. And if the Fed acts rationally moving forward, I think inflation will slowly come down. The other thing you have to keep in mind is they can't, 5-year inflation break-evens were at 2.17 yesterday, down from 3.59% in March. So they've been successful in the aggressive hawkish talk and dovish action. And when I say dovish action, when you step back in the scheme of things, a 3% Fed funds rate is not overwhelming considering the level of inflation that we had just a few months ago. So they may have navigated the perfect situation as long as they don't overstep and create another BOE situation, which causes some contagion. As far as Credit Suisse, it's a pimple on the financial systems. But I mean, either if conditions are good in a few weeks, they'll raise some equity from the public. If they're bad, the Swiss bank will backstop them and probably equitize them a little bit if needed. But in the scheme of things, they're a relatively small operation by their own doing. They were at one point a decent-sized operation with influence, but every single crisis over the last 10 years, they're always right in the middle, whether it's Archegos, anything that could go wrong on Wall Street or a dumb deal that they could get involved in, they were always first in line with their hand out. And it's sad, but it's kind of comical at the same time.
So bottom line, you're not buying into the argument by, for example, Michael Burry that after the multiples compression, we should also downgrade stocks because of earnings season coming up, as I understand you. By the way, I just saw this tweet by Michael Burry that he's like kind of seems like bullish on China as well. So maybe that's something he got in common with us. And yeah, you still sound bullish. And so thanks again. It was really awesome, again, talking to you. Lots of great insights. Let our viewers know where they should seek out and find you and follow you. And then I think at some point we should check back again and see where the markets were going.
Sounds great, Marcel. Well, I've got the website hedgefundtips.com. Over there, I publish a weekly research note every Thursday morning. I publish a weekly podcast and video cast every Thursday evening. And you can enter your email there, so you'll just get it automatically emailed to you. You can remove yourself anytime. We also have a free text message, so if you put your cell phone in there, you'll just get texted twice a week on Thursdays for the note and for the podcast. You can also remove yourself anytime. On Twitter, we're @hedgefundtips. That's where you can get all of my Twitter updates. and then that'll lead you to our YouTube and everything else where you can find us. But I really want to thank you for having me on. You've really built a wonderful audience over the years of smart people interested in the opportunity, the contrarian opportunity in China right now. Soon it will be consensus. I know it's hard to believe, but another 12 to 24 months when everyone is singing from the same hymnal that we've been singing from for the last 12 months by ourselves, so 6 or 12 months by ourselves, everyone will be joining. It will be a chorus, and that's when we want to exit the church.
Exactly. Thank you so much, Tom, and see you next time.
Thanks, Marcel.